Hey everyone, it's August 19th, 2015. In this week's video, I'll keep it short and simple and draw your attention to the S&P 500, a few performing and underperforming sectors of the market, and share with you a couple of charts that I think speak a great deal of volume of what's to come over the next few weeks and months. I want to begin this week's video by talking about the industrial sector, the XLI. Drawn on the weekly chart of the XLI, I've highlighted three different instances where piercing pattern has emerged. As opposed to the piercing pattern set at the beginning of 2014 and in October of 2014, the piercing pattern that was set 5 weeks ago failed to push the index and by default the broader markets to new all-time highs. Aside from signaling a change in bias and momentum to the broader trend, it also signals a change in market sentiment or market participation and perception as a whole. In a quiet tape such as the one we have today, where again the bias and momentum of a particular trend is essentially flat or neutral, these are the type of nuances you want to focus in on. These signals are not to be used as absolute signals, meaning they're not to be used alone in order to arrive to a conclusion or draw upon a thesis, but there are some factors you have to take into consideration. Again, the fact that this piercing pattern did not lead to a new high is worrisome, but it does not signal, as of yet, a broader imbalance in the sector or in the broader markets. If you look at a leading sector like biotechnology, no longer are we seeing investors buying into measured dips as they once did and selling on rips. Let alone are they buying or paying up for price as they did back in 2013 and through much of 2014. The fact that the IBB, which was a leading sector going back as far back as a few weeks, again reaffirms this observation I'm taking note of, and it's something that again you have to take into consideration and acknowledge that it's actually taking shape. The XLV is the same story, even though it's showing a bit more strength than the IBB. If you narrow your perspective and take a look at the daily or even an hourly chart of the XLV, you'll see the same phenomenon taking place where essentially investors are not only selling into rips, but beginning to sell at the bid or into perceived weakness. As far as the S&P 500, it's setting a rounding top at the current range, as opposed to in the past where we saw rounding bottoms followed by sharp advances in price where essentially new 52-week highs and all-time highs were set. Today we're seeing a rounding top being formed. Again, rounding tops are not inherently bearish, but they do increase the probability of a possible wider price imbalance being formed in the not so distant future, especially if the range as far as time is concerned, is wider than previous ranges. So since we've really been consolidating since the beginning of the year in the SPX, if the SPX were to break down, it could lead to a wider sector imbalance as represented in price. Now, what will ultimately decide the fate of the S&P 500 or where it heads over the next few weeks and months? It's going to be price. I mentioned before how 2045, 1980 are key levels in resolving this range in the S&P 500, and those levels remain today. For there to be, continued selling or increase, or the pace of selling to increase quite notably, we would have to see the S&P trade below, or come to trade comfortably below 2000. As you can see, the trend line I've drew here connects previous tops dating back to the major low set in 2010, and it's drawn across time. If the S&P were to break down over the next few weeks, it would come right in line with the 2000 price point I've highlighted on and off over the last few weeks. Again, this is more of a commonality than an actual tool anybody should use to, this sort of conclude what markets may or may not do in the not so distant future, but it's something that should help you view what the broad trend or many would be looking at. Finally, I want to draw your attention to a few charts that I think are important and speak a great deal of what is happening today and what may happen in the near future. First, I want to draw your attention to the Bank of America Merrill Lynch distribution of how clients are basically positioning themselves ahead of a particular move. Um, Two things I should point about this chart. First, it's a 4-week moving average, meaning that trends are normalized since these price points are normalized through time. And second, this distribution I'm showing you right now, it only accounts for the first week of August. Nevertheless, if we take a look at the same readings posted by the same firm going back as far as the first week of July, it follows the same pattern. So that's something you should take note of. But as a whole, or in aggregate, we've seen institutional clients, private clients, and hedge funds sell into price over the last few weeks, or most certainly in the first week of August. The only net buyers were corporates. Um, just last week, Alibaba, when they reported earnings, the company reported a $4 billion share buyback program over 2 years. I mean, this is for a company that's valued at over 200 billion and has 100 billion in cash. So certainly, they see share buybacks as the more efficient way of allocating their cash reserves. But whatever the case may be, and whether it proves to be a worthy trade or a worthy investment over time remains to be seen. But the fact that institutions, private clients, and hedge funds are selling into corporate hands uh, tells me a bigger move lies ahead. Again, we don't have enough price signals to really identify if it's going to be or lead to a breakout or a breakdown. But what I do know, and what I've reiterated over the last few videos, is that it's going to be volatility is going to be heightened over the fall and winter months, and even if markets do break out higher. Now, if markets break out higher, all this money that's been selling into the hands of corporates, like institutional private clients, hedge funds, are going to have to chase. So that could lead to a bigger price breakout than initially expected. Still, however, I expect 2181, the S&P, to serve as an intermediate top. If not, then you could see a wave of selling hit markets viciously, just like every downturn has taken shape over the last few weeks, where selling begets more selling, and it takes anywhere between 2 to 6 weeks for those trends to normalize or play themselves out before some buying interest is drawn back into the markets. The other part of this, or that could potentially lead markets to either price themselves lower than most would like to see or initially believe, or even priced higher, is the fact that there's too much liquidity, not just in debt markets, whether it be in the United States or Europe, but there's illiquidity everywhere. That's including the FX markets and even equity markets. For every price move, the standard deviation has increased over the last 15 years. This means, again, even though volume levels have come higher or higher than they were 10 to 15 years ago, it's come at the expense of liquidity. Part of this could be investors positioning themselves ahead of a possible rate hike in September. But if a 0.25% rate hike in the Fed funds rate causes so much illiquidity across most major markets, you would have to assume that a notable and a worthy 2 to 4% increment in the Fed funds rate is going to could possibly lead to complete collapse in liquidity. So that tells you the time, or a sign of the times that we live in today, and the risk that exogenous risk that really no firm, no investor can possibly quantify nor understand. So the skinny of the story, long story short, is that illiquidity is going to continue to be a prominent theme over the next few weeks, and it will most likely lead to heightened volatility, whether the markets break out to the upside or break down, of course, to the downside. As of now, everything hinges, or most of it hinges, on what the US dollar, and by retrospect, what the price of crude oil does. Again, I won't get overly bearish or somewhat bearish in the markets unless we see a breakdown to begin with below 2045 and 2000 in the S&P. From there on out, we'll have to draw on different trends to see where a possible bottom may actually lay. So with that said, I want to thank you for taking time to watch the video and wish you the best.